Something extraordinary just happened in the gold market, and if you're not paying attention, you're about to miss one of the most significant wealth transfers in modern history. A massive institutional buy order just crossed the tape. We're not talking about retail investors buying a few coins. We're talking about the kind of volume that moves markets, the kind of order that signals something much bigger is coming. And here's what should terrify you. This isn't the first one. It's part of a pattern that's been accelerating for months, hidden in plain sight while most investors are completely oblivious. Let me show you exactly what's happening, who's behind it, and why this could be your last chance to position yourself before the real move begins. The order that just hit represents tens of millions of dollars flowing into physical gold. But that's just the surface. When you dig into the data, you start to see something that looks less like normal market activity and more like preparation for a seismic shift in the global financial system. Central banks have been buying gold at record levels for 3 consecutive years, over 1,000 metric tons annually. That's not normal market behavior. That's strategic accumulation. These are the most sophisticated financial institutions on the planet, with access to information you and I will never see, and they're loading up on physical gold like their survival depends on it. Because it probably does. Think about what central banks know that we don't. They see the real inflation numbers before they're massaged for public consumption. They understand the true state of sovereign debt. They know which dominoes are wobbling. And they're converting their paper assets into the one asset that's survived every financial crisis in human history. The World Gold Council data shows something remarkable. In the third quarter alone, central bank gold reserves increased by nearly 30% compared to the previous year. Even with gold trading at record highs, they're still buying. That tells you everything you need to know about where they think prices are headed. But let's talk about who's really driving this whale alert we just saw. The smart money isn't waiting for confirmation. They're not waiting for gold to break through some magical price level, or for the mainstream media to finally wake up and report what's happening. They're accumulating now, while most investors are still debating whether inflation is transitory or wondering if stocks can keep climbing forever. Look at the institutional flows. Major hedge funds have been quietly building positions. Family offices that manage generational wealth are allocating more to precious metals than they have in decades. These aren't speculators chasing momentum. These are wealth preservers who understand that the rules of the game are changing, and the game is changing faster than most people realize. We're watching the slow-motion collapse of the post-1971 monetary experiment. When Nixon closed the gold window and severed the dollar's link to gold, he unleashed an era of unlimited money printing that's now reaching its mathematical endpoint. You can't print infinite currency and expect it to maintain its value forever. Eventually, reality catches up. The numbers are staggering. Global debt has exploded to levels that would have been unthinkable a generation ago. Governments are spending money they don't have, on promises they can't keep, using a currency that's backed by nothing but faith and the threat of military force. And that faith is eroding. Look at what's happening with BRICS nations: Brazil, Russia, India, China, South Africa, and now dozens of other countries joining or seeking to join. They're not just talking about alternatives to the dollar anymore. They're building the infrastructure to trade without it. They're settling oil contracts in yuan. They're creating gold-backed trade mechanisms. They're systematically dismantling dollar hegemony, and every step they take in that direction makes gold more valuable. Here's what most analysts miss. They look at gold as just another commodity, subject to supply and demand dynamics like copper or wheat. But gold isn't a commodity, it's money. It's the only form of money that can't be printed, debased, or inflated away by desperate governments. When you understand that distinction, everything else makes sense. The massive buy order we just saw isn't speculation. It's recognition. Recognition that the monetary system we've lived under for the past 50 years is entering its final phase. Recognition that the wealth stored in paper assets is at risk. Recognition that physical gold is the ultimate insurance policy against systemic failure. Let me paint you a picture of what's coming. Imagine you're a sovereign wealth fund manager responsible for protecting billions of dollars. You're watching the Federal Reserve's balance sheet balloon to levels that would have been considered insane just a few years ago. You're seeing other central banks follow the same playbook. You're watching debt-to-GDP ratios climb into territory that historically has always ended in currency debasement or default. What do? You buy gold. Lots of it. Quietly. Consistently. Without announcing it to the world. That's exactly what's been happening. The official numbers show record central bank buying, but those are just the purchases they're required to report. the real accumulation is likely much higher. Some nations are buying through intermediaries. Some are mining domestically and keeping production off the market. Some are acquiring gold through bilateral trade deals that never show up in the official statistics. The evidence is everywhere once you know where to look. China's official gold reserves have been climbing steadily, but analysts who track their import data and domestic production estimate their actual holdings could be several times higher than reported. Russia has been converting dollar reserves into gold for years, building a war chest that insulates them from Western sanctions. India's central bank has been a consistent buyer. Turkey, Poland, Hungary, Singapore, the list goes on. These aren't random purchases. This is coordinated de-dollarization. And here's where it gets really interesting for you. While central banks and institutions are accumulating physical gold, the paper gold market is showing signs of extreme stress. The COMEX, where gold futures are traded, has been experiencing unusual volatility. The ratio of paper gold to physical gold has been climbing. That means there are more claims on gold than there is actual gold to deliver. What happens when everyone holding paper gold decides they want the physical metal? We've seen this movie before. In 1971, when foreign governments started demanding gold for their dollars, the United States couldn't deliver. That's why Nixon closed the gold window. The paper promises exceeded the physical reality. We're approaching a similar moment, but on a much larger scale. The derivatives market for gold is massive. Hundreds of billions of dollars in contracts that represent claims on gold that doesn't exist. It's a house of cards built on the assumption that most people will never actually demand delivery. But what happens when that assumption breaks? You get a short squeeze that makes GameStop look like a rounding error. The commercial banks that are short gold futures are sitting on positions that could bankrupt them if gold prices spike. They're counting on being able to roll their positions forward indefinitely, always staying one step ahead of delivery. But the physical market is tightening. Premiums for physical gold over paper gold are widening. Delivery times are extending. The stress fractures are showing. And that massive buy order we just saw, that's someone who understands what's coming and wants physical metal, not paper promises. Now let me address something important. If you're sitting on significant retirement savings, you need to understand how vulnerable you are to what's coming. Most retirement accounts are denominated in dollars and invested in paper assets. Stocks, bonds, mutual funds. All of them are claims on a system that's showing increasing signs of instability. I put together a comprehensive guide on how gold IRAs work. It's completely free, and you'll find it in the description below. It covers how you can get physical gold into your retirement account without triggering tax penalties. If you have $100,000 or more in retirement savings, this is information you need to understand. Not because I'm trying to sell you something, but because the window to protect yourself is closing faster than most people realize. All right, back to what's happening in the market right now. The technical picture for gold is setting up for something extraordinary. We're seeing a pattern that historically has preceded major breakouts. The consolidation phase we've been in is creating a coiled spring. When it releases, the move is going to be violent. Look at the chart. Gold has been building a base above key support levels while the fundamentals continue to deteriorate. That's not weakness. That's accumulation. The smart money is using any dips to add to positions. They're not trying to time the perfect entry. They're building strategic positions for what they know is coming. The supply side of the equation is equally compelling. Gold production has been essentially flat for years. The easy deposits have been mined. New discoveries are rare and expensive to develop. Meanwhile, demand is accelerating. Industrial demand, jewelry demand, investment demand, and central bank demand are all competing for a relatively fixed supply. Basic economics tells you what happens next. But there's another factor that most people aren't considering. The energy cost of mining gold has been rising. It takes more energy to extract gold from lower-grade ore. As energy prices remain elevated, the floor price for gold production keeps climbing. Miners won't produce at a loss. That creates a natural support level that keeps rising over time. We're approaching a point where the marginal cost of production intersects with strategic demand from entities that need gold regardless of price. When that happens, price discovery becomes very interesting. Let me tell you a story that illustrates what we're dealing with. In the late 1970s, gold was trading around $200 an ounce. Most investors thought it was expensive. The conventional wisdom was that gold had already had its run and was due for a correction. But a small group of investors understood what was really happening. They saw the inflation that was ravaging the economy. They saw the loss of confidence in the dollar. They saw the geopolitical instability. They bought gold. By 1980, gold had spiked to over $800 an ounce. The investors who understood the fundamentals and ignored the noise made fortunes. The ones who waited for confirmation, who wanted to see gold break through resistance levels before buying, who listened to mainstream analysts saying it was too expensive, they missed the move entirely. We're in a similar setup right now, but the fundamentals are actually more compelling. The debt levels are higher. The money printing is more extreme. The geopolitical tensions are more severe. The loss of confidence in fiat currency is more widespread, and the central banks are buying more aggressively than they did in the 1970s. If gold went to $800 in 1980 under those conditions, where does it go now? Some analysts are calling for $5,000, some say $10,000. The more aggressive forecasts go even higher. But here's what matters. The direction is clear. The fundamentals support significantly higher prices. The only question is timing and magnitude. And that massive buy order we saw, that's someone who's done the math and decided the risk-reward is overwhelmingly in favor of being positioned now rather than waiting. Let's talk about what happens to your wealth if you're not prepared. Inflation is the silent thief that's been stealing your purchasing power for decades. The official numbers say inflation is 3 or 4%, but anyone who buys groceries, pays rent, or fills up their gas tank knows the real number is much higher. The way they calculate inflation has been changed multiple times to make it look less severe than it actually is. Your dollars are losing value every single day. The money you've saved, the retirement account you've built, the cash you're holding for emergencies, all of it is being systematically devalued by monetary policy that prioritizes short-term political goals over long-term economic stability. Gold doesn't have that problem. Gold can't be printed. Gold can't be debased. Gold maintains its purchasing power across centuries. An ounce of gold bought the same amount of goods 2,000 years ago as it does today. Can you say that about any fiat currency? The Roman denarius was the reserve currency of its time. It was backed by silver and accepted throughout the known world. Then the emperors started debasing it, reducing the silver content to fund their wars and social programs. Within a few generations, it was worthless. The empire collapsed. The currency died. Sound familiar? Every fiat currency in history has eventually failed. Every single one. The dollar has lost over 95% of its purchasing power since the Federal Reserve was created. It's not a question of if it will lose the rest, but when. And the smart money is betting that when is sooner than most people think. That's why you're seeing these massive buy orders. That's why central banks are accumulating at record pace. That's why family offices and hedge funds are building positions. They're not speculating on a trade. They're preserving wealth across a monetary transition. Here's what most people don't understand about gold. It's not an investment that you buy hoping it goes up so you can sell it for more dollars. It's a form of savings that maintains its value while everything else loses value. When gold goes up, in dollar terms, it's not really gold that's changing. It's the dollar that's falling. Gold is the constant. Fiat currency is the variable. When you reframe it that way, the question isn't whether you should own gold. The question is how much of your wealth you're willing to leave exposed to currency debasement. The institutional buyers who just placed that massive order understand this. They're not trying to time a trade. They're repositioning their portfolios for a world where the dollar is no longer the undisputed global reserve currency, where gold reasserts its role as the ultimate store of value, where the monetary experiments of the past 50 years come to their inevitable conclusion. And they're doing it now, while gold is still available at prices that will look absurdly cheap in hindsight. Think about the opportunity cost of being wrong. If you buy gold and the monetary system somehow muddles through for another decade, you've preserved your wealth. Gold will still be gold. It will still have value. You haven't lost anything except the opportunity to speculate in assets that might have performed better. But if you don't buy gold and the system breaks, you've lost everything. Your paper assets become worthless. Your savings evaporate. Your retirement plans disintegrate. The wealth you spent a lifetime building vanishes in a currency crisis that you saw coming but didn't prepare for. Which risk are you more comfortable taking? The massive buy order we're seeing is someone who's made that calculation and decided the risk of not owning gold is far greater than the risk of owning it. They're willing to pay current prices because they believe future prices will be much higher, and they have access to information and analysis that most retail investors never see. When the smart money is moving this aggressively, you should pay attention. Let me show you what the market structure is telling us. The gold market operates on multiple levels. There's the physical market where actual metal changes hands. There's the futures market where contracts are traded. There's the ETF market where investors buy shares representing gold. And there's the over-the-counter market where large institutions trade directly with each other. Each of these markets is showing signs of stress and dislocation. Premiums for physical gold are elevated. Futures contracts are showing unusual volatility. ETF flows are accelerating. And the OTC market, where the really big money moves, is seeing record activity. That massive buy order likely came through the OTC market. That's where institutions go when they want to move serious size without disrupting the public markets. The fact that we're seeing evidence of it means the order was so large it couldn't be completely hidden. What does that tell you about the conviction behind the trade? These aren't momentum chasers buying because gold is going up. These are strategic buyers accumulating because they believe gold is fundamentally undervalued relative to the risks in the financial system. They're building positions that they intend to hold through whatever comes next, and what comes next is likely to be turbulent. We're entering a period of unprecedented monetary and geopolitical uncertainty. The post-World War II order is breaking down. The Bretton Woods system that established the dollar as the global reserve currency is being challenged. The petrodollar system that recycled oil revenues into dollar-denominated assets is eroding. The assumptions that have underpinned global finance for generations are being questioned. In that environment, gold isn't a speculation, it's a necessity. The countries that understand this are accumulating. The institutions that understand this are repositioning. The individuals who understand this are protecting themselves. And the ones who don't understand it are going to learn a very expensive lesson. History is full of examples of what happens when monetary systems fail. The Weimar Republic, Zimbabwe, Venezuela, Argentina, Lebanon. The pattern is always the same. First, there's denial. Then there's inflation. Then there's hyperinflation. Then there's collapse. And the people who survive with their wealth intact are the ones who got out of the currency and into hard assets before it was too late. We're somewhere in the middle of that progression right now. The denial phase is over. We're in the inflation phase. The question is how long before we move to the next stage, and that massive buy order suggests someone thinks we're closer than most people realize. Let me give you some perspective on what gold has done historically during periods of monetary stress. In the 1970s, as inflation raged and confidence in the dollar collapsed, gold went from $35 to over $800. That's a 2,300% return. The investors who owned gold preserved their wealth. The ones who stayed in cash or bonds got destroyed. In the 2000s, as the housing bubble inflated and then burst, gold went from around $250 to over $1,900. That's a 760% return. Again, gold owners preserved wealth, while paper asset holders suffered massive losses. We're setting up for another one of those periods. The fundamentals are even more extreme than they were in the 1970s or 2000s. The debt is higher. The money printing is more aggressive. The geopolitical tensions are more severe. The loss of confidence is more widespread. If gold delivered those kinds of returns under less extreme conditions, what does it do now? The institutional buyers placing these massive orders have done the analysis. They've run the scenarios, they've stress-tested their portfolios, and they've concluded that gold is the best risk-adjusted position they can take given what's coming. You should be asking yourself why you're not doing the same thing. The window to position yourself is closing, not because gold is going to disappear or become unavailable, but because the price is going to move to a level where accumulating meaningful positions becomes much more difficult. When gold breaks through key resistance levels and the momentum traders pile in, when the mainstream media finally starts reporting on what's happening, when your neighbors and coworkers start talking about buying gold, it will be too late to build a strategic position at reasonable prices. The time to act is when the smart money is acting, and the smart money is acting right now. That massive buy order is a signal. It's telling you that someone with significant resources and sophisticated analysis believes gold is dramatically undervalued at current prices. They're willing to deploy tens of millions of dollars based on that conviction. They're not waiting for confirmation. They're not waiting for lower prices. They're buying now because they believe now is the time. Are you going to listen to that signal, or are you going to ignore it and hope everything works out? The choice is yours, but understand what you're choosing. You're either choosing to protect yourself against the very real possibility of monetary instability, or you're choosing to remain fully exposed to a system that's showing increasing signs of stress. One of those choices preserves your wealth. The other puts it at risk. The massive buy order that just hit the tape is someone making the choice to preserve wealth. They're not gambling. They're not speculating. They're protecting themselves against a future that looks increasingly uncertain. You should be doing the same thing. Not because I'm telling you to, but because the evidence is overwhelming. The fundamentals support higher gold prices. The technical setup is favorable. The institutional flows are accelerating. The central banks are buying. The geopolitical situation is deteriorating. The monetary system is under stress. Every indicator is pointing in the same direction. The only question is whether you're going to act on that information or wait until it's too late. The massive buy order we just saw is proof that the smart money isn't waiting. They're positioning now, while gold is still available at prices that will look like bargains in the years ahead. This is your moment. This is your opportunity to protect the wealth you've worked so hard to build. Don't let it slip away because you were too cautious or too skeptical or too comfortable with the status quo. The status quo is changing. The monetary system is evolving, and the investors who recognize that and position themselves accordingly are going to preserve their wealth while everyone else watches theirs evaporate. Be one of the ones who acts. Be one of the ones who understands what's happening and takes steps to protect yourself. Be one of the ones who looks back in 5 years and feels grateful that you paid attention to the signals when they mattered. That massive gold buy order is a signal. It's telling you everything you need to know about where the smart money thinks this is headed. The question is whether you're going to listen.